Hello, everyone. Welcome to a brand new show called Chat with Traders. Think of it as a closing bell 2.0. This is where we're interviewing the best of the best in FinTuit. And I'm truly honored that our first guest is someone who I usually call a man behind charts. You've probably seen his amazing charts on Twitter. I've shared many of them with our community, with you guys. Colin Thomas, he's the founder of top-down charts. He also has a Substack called Weekly Chartstone. He's nice enough to do an interview with us and be our first guest. Colin, welcome to the show. Thanks.
Yeah, thanks for having me. I'm looking forward to it. Looking forward to seeing the new series as well.
Yeah, absolutely. We're definitely very excited. I've shared and you're based in New Zealand. Is that correct?
Yes, exactly. So,
Is it
yep.
late there or?
No, it's 10 a.m. and it's 10 a.m. on Thursday. So yeah,
Okay.
we get the morning first. It's slightly ahead of time.
Well, we really
Yeah,
appreciate 10 a.m. on such a crazy day where you're getting news about,
yeah,
Credit Suisse and all the banks. So we appreciate your time.
yeah.
Colin, a
Oh, and
lot of
it's
our,
it's a great time zone actually because I don't have to sit there through the whole trading day and get all this news thrown at me. I can just wake up and see, okay, what's the market done? And then work backwards from there. Okay, it must have been some news. All right, what's the news? So yeah, because I
exactly.
mean, I think if you're sitting, I couldn't imagine just sitting there, you know, having each different headline thrown at me, and yeah, maybe there's something in that.
Yeah, it will be too much. So I think it's a kind of a blessing
Yeah,
in disguise, being able to just get all the
yeah,
information and then process it. Then, Colin, a lot of our community already knows you because I've been sharing your charts and your research with them. But if you don't mind, just a quick introduction of yourself, your background, it would be amazing.
yep, yeah, definitely. So I started top-down charts 2016, and before that I was in asset management. So on the buy side. At a couple of different fund management companies over this side of the world, Australia and New Zealand. And basically, throughout that time, really focused on investment strategy, economics, but being, you know, kind of these smaller countries over here, you tend to be in smaller teams, so you tend to get a bit of exposure, a bit of experience across the different functions, which was really quite good, in terms of just building the initial foundation of my career. And actually, one of the things that I found was really quite valuable through that time was one of the companies I worked for. They had basically fund of funds or asset allocators. So part of their job was to appoint managers, and so part of that is I got to sit in on and also run some of the manager meetings. So you're sitting there basically assessing and having them sell you and pitch you on why their investment process is good and how exactly they go about their process of trying to make returns for their investors. And you get to see all sorts of different strategies, and I think that gives you a couple of things. First of all, it gives you appreciation for the fact that you know um, you can get quite myopic or focused on yourself or your own sort of peer group of different traders. But uh, when you take a step back and kind of explore things a bit more, you can see that there's so many people taking so many different approaches in the market, and be that asset class, be that time frame, be that the style that they or the factors that they use, whether they're systematic or discretionary. And I think the appreciation point there is that you know we can both be right. Like we could be two different investment managers or two different traders, investors, taking a completely different approach. We can both be right on our time frame, and we could both actually make money. So because it's often sort of it's a win lose thing. One person wins, the other person loses, and within a certain context, that's right. And I think maybe at the aggregate, it's right. But yeah, the other thing that it does is it gets you thinking about your own process, and I think that is something that is probably under allocated in terms of time and energy that people, uh, that I was supposed to just introduce myself, but I think that um, the point there is that a lot of people kind of just dive into investing or trading, and um, you know, especially ones that kind of got into it in the last couple of years
Yeah.
without really thinking, what am I trying to do? What is my process? What is my framework? Um, you know, how am I going to reliably make money over the longer term
Yeah.
rather than try and get rich and quick in the short term?
Yeah.
So, I mean, bringing that back to sort of me and what I'm doing, that that background in funds management helped inform what I do at Top Down Charts, and one interesting thing too. I've been going now since 2016, as I mentioned. It's not a huge amount of time, but it is. It's over half a decade now, and the types of clients I have there are institutional investors, asset allocators, insurance companies, hedge funds, wealth managers, fund managers, and one sort of just kind of thought of it now, but one interesting side effect of having those type of people as your client base, they're smart. That's their job, and one part of their job is to ask good questions or hard questions. And
Yeah.
the more of those hard questions you get, the more you actually develop. And certainly I've kind of noticed myself and my product, or what I my outputs evolve and develop as a consequence, or happy side effect of that. And so yeah, and here I am today, still doing top down charts, and yeah, the the cycle is always sort of different, but there's a lot of common themes, and uh, pretty interesting stuff going on at the moment.
Yeah, absolutely. It's so interesting that you mentioned about your framework and really understanding is, when we work with traders and even for myself and for my own portfolio, I'm always trying to dissect my returns. Like, where is this return coming from? Is it coming from excessive leverage? Is it coming from tactical change? Is it from timing? Is it from being overweight or underweight? Kind of really dissecting your information
Mm,
ratio per se. And I think it's something
mm,
that especially a lot of traders, and at least on the retail side, people that have started a couple of years ago really need to understand, the market regime, and where is that return coming from? Is it the excess
mm,
liquidity? Is it the excess leverage that you're taking, or no, is it really timing and you've really crafted something and you kind of have defined your edge?
mm.
Kind of on top of
Yeah.
that, I want to talk about top down, kind of a more of a macro, even though your framework is actually a lot broader than that, and we'll get to it. Have you seen your business pick up in the last 2 3 years? Because I feel like in the zero interest rate period, not a lot of people were really thinking about macro or what rates and the impact of rates. And we saw a lot of
Mm.
2%, 3% cap rate real estate, especially here in Canada. So have you seen your business pick up, in the past couple of years with all the rates uncertainty, and did macro all of a sudden become important?
Yeah, I mean, when you're kind of a small growing business, it's hard to kind of tease out sort of macro conclusions from your own sort of data there. But I mean, one anecdote is that 2020 was like my best year in terms of new clients, and it's an interesting dynamic on that, because in the really tough times, uh, the demand for research and the value of research goes up, or the value of good research um, goes up. But then, against that, sometimes there's cost cutting and budget freezes, and all the rest of it. But those that do kind of put investing returns first, that research first, that focus on the quality of their product rather than the constraints of necessarily shareholders and commercial aspects. Those funds are the ones that do continue to spend and invest, and you know they're the ones that you want to ideally be doing the most business with.
Yeah.
But Yeah, definitely. It was interesting, and when I sort of first got started, 2017, 18, it was one of the common complaints or remarks that I got was, especially the hedge funds in there, they were like, oh, it's kind of boring. There's no volatility. We can't make money. Well, now they got what they wished for and a little bit more, I think.
Yeah.
But there is that point though that when you're asset allocation focused, and especially if you're global asset allocation focused in your research, and at least for the American like financial advisors, etc., they've just seen the S&P 500 go up in a straight line, and
Yes.
they've seen rest of the world kind of lag behind, and they're thinking, well, why would I? I don't need asset allocation. Um, I don't need global shares. I don't need commodities. I don't need cash. I just buy the S&P 500,
Yeah.
um, which is, yeah. I mean, it's understandable
Yeah.
because one element that you're kind of dealing with in the professional fund management space is that of peer risk. And so if you're sitting, if everyone else, right, as long as S&P 500,
Yeah.
that's all they are, and you've got like a intelligently, um, well thought out portfolio that's a bit more diversified, and it's skewed towards places where there's more risk, more opportunity versus risk.
Yeah.
Uh, you might be right, but then you're underperforming your competitors, and then that can lead to all sorts of unpleasant conversations.
Yeah, definitely.
Mm,
Especially if you're managing money for clients, it's so interesting you mentioned that. Like recency bias is one of those things. It's so amazing to me because, like for example, past 10 years,
mm,
obviously Nasdaq outperformed, and people are always just looking back at the Nasdaq chart and saying, "Oh, if I invest, I can double my money every 5 years, or if
mm,
I add a little leverage, maybe do a 2x leverage, I could do." But you have to look at asset allocation as a whole. It's a really holistic
mm,
approach. Nasdaq might
yeah,
not outperform just how it did, and
mm,
we saw it even with some of the funds that got really popular in 2020, and they saw a massive inflow.
mm,
I mean, you're looking at volume by
yeah,
price analysis. A lot of people who invested are down, right? So
yeah, absolutely. And I mean, it's the. I mean, if you, I kind of look at it at the high level, but if you looked at it at the individual level, you'd say it's actually quite sad. But it's quite predictable, and I mean, we're kind of not. It's not our job to say, it's this is nice or not. It's
yeah,
you know, your job is to understand value, because ultimately price paid is very important. Uh, Leveraging 2x into Nasdaq in late 2021, versus 2009. Two very very different things.
exactly.
Two very very different prices,
Yeah,
valuations.
yeah,
Two very different crowd psychology,
yeah,
monetary policies.
yeah,
And yeah, so
yeah. It's
that's the thing. You definitely pay attention to what has occurred recently,
yeah,
but you assume that that doesn't mean that it carries on like that forever. You
yeah,
you say, okay, this is the recent experience. What does that mean for forward-looking returns? Just even mathematically, we can kind of work that out.
yeah. Yeah, exactly.
Mm,
I think Warren
yeah,
Buffett has a quote. He says, "I think price is what you pay, well, value is what you get." Right. So it's it's the levels you're buying
yeah,
is very important.
mm, yeah,
So just getting to kind of your framework,
mm,
just that holistic approach. Can you walk us through your framework? Because you're, one of the technical analysis, I feel like at this, like the places I've worked at, it was kind of taboo. They didn't really use it,
mm,
but some places use it. Your framework has monetary policy in it, valuation, market cycles. You use sentiment as well as technical analysis. Can you walk us through your framework a little bit? How did you? I'm
mm.
assuming it's part of your background, but how did you come up with all these little many factors?
Yeah, so I mean, in terms of how did I come up with it to begin with, it's probably really just understanding what best practice kind of looks like from seeing it firsthand, but also seeing the pitfalls.
Yeah,
So I saw managers that were very value focused that ended up having long periods of underperformance.
yeah,
Because that's I guess the problem with valuations. Valuations are great. They're a really good starting point and something that you should never ignore. But you, you know, unless you have the luxury of being able to look at valuations and make a decision based on that, set and forget, and close your eyes and not have to worry about it for 5 years.
yeah,
Which is very few people, I think. The rest of us have to say, okay, this is the valuation starting point. It's cheap. Like we'll just say that it's cheap for argument's sake, and the next step is okay, but what how do we actually how do we actually act on that? How do we take that from saying valuations are cheap um, to either making a decision on that or taking it to a committee, or in my case, presenting an idea to clients, for instance.
yeah,
It's you have to bring on all these other factors. So um, the stage that you're at in the cycle matters. The settings and direction of monetary policy matters immensely.
yeah,
Um, and I think that's something everybody's, I think, quite across that now. But I think back in 2020, even 2019, actually, people were they kind of lost, I think, to some degree, the notion that monetary policy is an important factor,
yeah,
and then sentiment technicals as a means of kind of rounding out that view. So as a worked example, March 2020 valuations got to really cheap levels. The cycle factors, so basically the macro got so bad that it's good, and the monetary side of things, everything was going full blast. Sentiment washed out, technicals oversold, and then also had that bottoming signals for the technicals. So, and then that's kind of one example of working it through on the buying side of things. But in terms of technical analysis, or any factor really, I would say it's best not to be too dogmatic about things. You want to be pragmatic about things, and you know, I lay my framework out in this kind of block by block by block kind of thing. But I'm happy to bring in any piece of information that I can that is I think of it as puzzle pieces, and I'm trying to build a puzzle there. And the more pieces that you can put on that puzzle, then the better idea of the picture. If you only have two pieces in the puzzle, you know,
yeah,
it's pretty hard to guess what the picture is
yeah,
most of the
exactly.
time. But I think technicals are really good for two things. So first of all, would be to generate an initial suspicion or an initial clue that something might be there. So, for example, if something's breaking out,
Yeah,
let's go and see the rest of the case. Is it does the monetary, the macro, the value, any other factors, do they all align up with that? And then the other end is okay, I've got the rest of it already built up. This thing looks cheap. It's the cycle's turning from depressed to turning up, and monetary's easing, sentiments overly bearish, and now we've got these technical signals that are saying now's the time, it's breaking out, or it's turning up from oversold, bullish divergence, what have you. So I think that using it to complement the rest of the things, and I think also just from my experience, technical analysis can save you
oh
um,
yeah, yeah, big
from
time.
being like stuck in because the problem is if you're too focused on fundamentals, fundamentals can be quite slow moving. whereas price moves all the time. Price moves faster than fundamentals. If you believe in some level of market efficiency, then that's the same thing as saying price is actually reflecting fundamentals. And so, you know, I mean, one way of looking at that is saying that there's all these smart people that are spending all this money, all this resource, figuring out what to do, and then they're making decisions based on that. That's showing up in price, and so price is actually an indicator of what those people are actually doing, and so
Right.
you can just piggyback off what they're doing by just following what the price is doing.
Yeah,
Yeah,
I've heard that before. Kind of like a price is the forward looking, actually. It's actually the forward looking indicator when you're looking at the
yeah,
price.
but also price can be wrong.
Yeah, that's
Yeah,
true. Yeah, exactly.
and I mean that's in a certain to a certain degree that's you know to a certain degree you're basically saying like whenever you make a decision that the price is wrong, or that price today relative to where it will be, can be, should be, is wrong. And so that's kind of one of the interesting aspects about this whole thing is where there's a sort of a degree of arrogance or confidence that you have to, um, or almost irrational confidence that you have to actually be deploying, but obviously on the back of something that you can actually base it on.
Yeah, no, definitely. I think you have to have some sort of a level of not overconfidence, but a little bit of confidence to even be a market
Mm.
participant these days.
Yeah.
Talking about, you mentioned, sometimes price is wrong and kind of shifting a little bit towards the market and everything that is happening. Where are you seeing kind of the pockets of opportunity in terms of, mispriced assets or asset classes? So, I don't know, like for
Mhm.
example, on my side, I mean, just until a week ago, I mean, this is now old news, but since last week, I was saying, the credit default swaps are very, very tight. The AAA the yield on AAA bond was lower than the treasuries at some point, and it was very mind-boggling to me. So I felt like last week I felt like, okay, there is some kind of a misprice in credit, and of course we saw it this week. But where do you think right now there's some opportunity, or maybe some asset classes are mispriced per se?
Yeah, definitely credit,
Yeah.
which I'll get onto in a second. But you definitely credit, but also I think on the bullish side, frontier markets, definitely worth a closer look. Same thing, China A shares,
Yeah.
uh, just about everything in alignment there. Of course, you've got to get past the geopolitical regulatory risk.
Yeah.
Uh, Emerging debt, which also, I mean, we still need a couple of things to go right there. Um, and also, again, there's probably a bit of a mental hurdle that people need to overcome on that one. I think treasuries too, but um, it, well, definitely bullish on treasuries, but there is a matter of timing, and there's also the inflation risk outstanding. But I think credit's probably where it's a little bit more straightforward and can kind of talk through um, some of the detail around that. Um, and I mean, the first thing is credit. Clearly, at the moment, it's not priced for a recession,
Yeah. Yeah.
which and that's okay because, or how to say, kind of like the VIX. Like the VIX is generally going to be low outside of an actual crash, and because crashes aren't kind of predictable, otherwise, it wouldn't be a crash. Um,
Yeah.
then VIX is kind of, it'll stay low until something happens and then it goes high. And same thing with credit. Um, Generally, will kind of stay low until you actually get the recession, until you get the default cycle. Uh, and so, I mean, if I look at credit at the moment in terms of the credit spreads, and so I kind of focus on the credit spread side of things. So, I mean, if I'm thinking about corporate bonds as an asset class, well, it's probably a little bit more complex at the just thinking of corporate bonds themselves, because you've also got, like, if you're sitting there saying, well, duration, treasuries, if they're going to rally, then any bond, is going to kind of improve in price because of that. It's then a matter of, well, does the credit side of things offset that? So I guess if we just focus on the credit spread aspect, I've got half a dozen to a dozen different indicators that are pointing to basically the fact that credit spreads are sort of about half of where they need to be. One of them is the Credit Managers Index, so the CMI, which is the credit manager version of the PMI.
Yeah.
And so that's been on a pretty sharply deteriorating at the high level. Sales and approvals have fallen off very sharply, and even the bad factors, so like bankruptcies, accounts placed for collection, those been trending in the wrong direction. And then also like the lending standards of the banks. So the banks, they were already beginning to tighten up, and I think you actually shared or commented on one of those charts where the bank lending standards, basically they're tightening up. So the Fed does a survey of bank managers and says, are you easing standards? So are you making it easier for people to get a loan? Or are you tightening? Are you making it harder for people to get a loan? Are you tightening the terms, raising the cost of funding, the cost of the loan over the spread over the funding costs? And that was already on a tightening trend. And the reason they do that, so this is kind of twofold. First of all, they're thinking, okay, conditions are deteriorating, interest rates are going up. That's going to put pressure on borrowers, house prices, commercial real estate going down. That raises questions around asset quality.
Yep.
And so basically, from their point of view, if you're investing money as a bank, lending money, your payoff profile is if you're a borrower, if the person that you're investing in pays you back, that's good. You get a little bit of interest. If they don't pay you back, that's bad. You lose everything. So it's not a good payoff profile. And so, I mean, versus if you're putting a little bit of money out and you're getting all of the upside, that's a very different payoff profile, and you can be a bit more cavalier, and you can kind of look through the headlines. But for banks, they've got to be a lot more careful. And in practice, it becomes it can become a bit of a vicious cycle as well, because the banks will tighten up. That makes it harder for people to borrow money, and that can actually accentuate things, because at the aggregate level that reduces demand, maybe even increases the likelihood of recession, maybe increases the likelihood of failure for some borrowers. But overlay that with the fact of what's happened over the last week. Are banks going to be more likely to lend or less likely to lend after all of this? I'd say probably less likely to lend.
Yeah.
I mean, going through this kind of situation, and especially if you've had doubts over your ability to raise funding or keep funding, then you're probably going to be maybe even just not making any loans, just holding off and applying a bit of a wait and see approach there. And so, I mean, tying it back to credit spreads, things are clearly trending in the wrong direction, and there's also the risk that it can kick off a bit of a default cycle, or a bit of a vicious cycle in its own right. And then just looking at the level of credit spreads, you're not really getting compensated for credit risk in the event that recession does come, which, if anything, I think that the odds are higher after what's just happened. Yeah,
it's so interesting. I mean, so many great things you mentioned, and I want to touch on them one by one. But I was having a conversation with a friend, I think last week, and we were talking about S&P earning yield and treasury yield. I was saying, just the finance 101 of the efficient frontier. There is no reason for me to really move on this curve in this efficient frontier. I'd much rather be on the left-hand side. And another thing that you mentioned that I think was really interesting was the payoff profile of the banks, and that kind of symmetry of a fixed payoff, but if things go wrong, the losses can be unlimited. And the payoff is kind of similar like to selling premium or selling puts. Your gain are
Exactly.
very limited. Your gain are very limited, but if things go wrong, and we love to crucify banks a little bit and say they're a risk taker and they're this and that, but that's the nature of their business. If anybody knows banking, if they don't take risk, they can't make a lot of money.
Yeah, and it goes in cycles too. Like, you know, I did among all the different degrees I did masters in banking and spent a lot of time on the history of banks, and it's very reliable
Yeah,
that about every 10 years or so that you get a banking crisis. And I mean, part of that is just the regulatory cycle, sort of a regulatory catch up,
yeah,
and, the regulations tighten and regulations ease. You know, people are like, oh, the banks are too out of control, they're too risky, we need to tighten up regulations. And then you wait a bit further, and then the banks lobbyists say, we need to ease these regulations that makes it tough to do business, stymieing everything.
yeah,
You also have just the progression of people through the business. The old ones that experienced the previous crisis retire
yeah,
or get pushed out, and then the new ones come up. They want to make their bonus. They want to make a name for themselves, and so they push the risk curve out.
yeah,
Or the memories of past failures kind of go into the rearview mirror, and people kind of forget about it. They try a new way of doing things, and in banking, there's really not any new way of doing things. It's just different risk tolerances.
yeah, exactly.
Um, and it's kind of a classic case of that, I guess, is you know let's ignore best practice and all the things that we'll kind of learn from history of what a bank should and should not do, and we'll just ignore that and we'll try something else.
Yeah.
um, yeah.
It's I mean we're gonna get to SVB and the Silicon Valley Bank and banking in a bit, but I had a really rough weekend, just to be honest with you, just seeing how we handle this, and I mean they say it's not a bailout. In my opinion, it's a bailout. I felt like it set a really bad precedent and a really major moral hazard. But we'll get to it. I want to stay a little bit on market, because you mentioned you feel like the credit spreads are probably half where they're supposed to be. I was reading a report, I think it was by JP Morgan, in terms of the quality of earnings. So a lot of the earnings are,
and and that is a moving target too. So
yeah,
where the indicators are sitting at the moment, and if we do get recession, then that moving target is going to
move.
be like,
Yeah,
exactly, yeah. So they might actually only be a quarter of where they
that, that
need to
that's
be.
That's true. No, exactly. Everything is moving in the market, right? New data is constantly coming in, and
Yeah.
models are changing. But I was reading that report, I think it was from JP Morgan, on the quality of earnings and how much of it is accrual basis. It's one of the lowest quality of earnings. At the same time, I saw a chart on the revenues of S&P 500 and the margins. And a lot of the next 12 months earning estimate that has been coming down has actually been because of margin contraction and not really the revenue. Revenue has actually held up really nicely. I want to talk about the soft landing island and how crowded is it. Do you think it's possible, the soft landing, in your model, in your macro framework, what are you seeing? I talked about it. I said when the labor curve is this steep, a small increase in demand is going to cause a massive price increase, right, in kind of econ. So I just feel like it's not feasible. It's impossible for a soft landing. That's just my 2 cents. But I would love to hear yours.
Yeah. No. No soft landing. I mean, so one of the things I've kind of been doing a lot more work on in the last couple of years, just given the stage of the cycle that we're in, is really just building out, well, adding onto all the different leading indicators and just kind of accumulating them. So, I'd have a dozen different charts, different leading indicators sitting around different sheets. So I brought them all into one sheet, and 20 different leading indicators across different factors. So, central banking related factors, monetary conditions, cost related pressures, measures of short term demand, and also across different regions, and so US, global, etc., emerging. And across those 20 leading indicators, they're all pointing in, they're all basically saying the same thing. And they're all, most of them are at their worst levels ever. And maybe there is a little bit of distortion due to the rate of change kind of stuff that's been going on over the last sort of 3 years. But when you look at that many different um, indicators, data points, and this is like, at a certain point you just say, well, we're just looking at the data. We're not actually forming an opinion in a vacuum here. We're not just, overlaying what we think should happen. We're just looking at data that, we've got sort of this long history of, and whenever that thing goes down like that, recession happens,
Yeah.
or at worst, at best, a slowdown happens. But just the breadth and the depth of those signals, for me, it's hard to, overlay some kind of bias against that. I think when the data's sort of screaming at you that loudly, at this point for me, it's kind of like, well, how would you get a soft landing? It would be some kind of surprise. At this point, you'd have to have, I don't know, maybe all of a sudden central banks say, oh, we don't care about inflation anymore. We're just going to pump stimulus in, or, fiscal policy goes from, oh, we need to raise taxes to, no, we're just going to put a flood of money into the system.
Yeah.
Maybe some of the China reopening can be something that can offset some of those headwinds. But I think coming back to, I mean, there's two things that we kind of need to rely on, or that we can rely on, and we keep coming back to. And one is, what is the data telling us? What is it explicitly telling us? But then also, what is the logic behind that? Because that's the other thing, is we don't just want to have, go and mine the data, put together some fancy leading indicators, play around, and all of a sudden it's telling us something. We want to be like, hang on a minute, is there actually logic to this? What is the intuition behind this? And on that front, if we just kind of lay it out there, so cost pressures, are pretty intense, as you mentioned, with profit margins coming down, and then, so that's one thing, and that's for everyone, right? Especially consumers.
Yep.
Interest rates going up at the fastest pace in recent history. Balance sheets contracting, and then also sort of shock effects from what's happening in the markets. The negative effect on confidence of that, and you kind of just work those through, and it just kind of makes sense. And we have this thing called a business cycle that's kind of gone on for quite a long time, and to kind of just say that the business cycle is not a thing, and let's just pretend it's not a thing.
Yeah.
I think that most of the soft landing argument is either some kind of denial of all that stuff, or maybe it's a fixation on the more recent or the lagging data. So that's probably one of the key pushbacks is you get is people are like, oh, the labour market's really strong.
Yeah.
Yeah, you're pointing to a recession, but the labour market's strong. Yeah, but jobs good. but then that's the labour market's
The last
um,
leg
the
of
last
the,
one to know.
yeah,
Yeah, exactly.
exactly.
Yeah. So yeah,
Yeah,
I don't see any way to get a soft landing, and probably and against that as well as with the FTX, with SVB, with who with Credit Suisse or whatever else. Um, we don't know the unknowns as well. That maybe there can be something that could surprise to kind of cancel the recession,
yeah,
but there's equally and probably more things that could deepen the recession that can surprise as well.
yeah. I think one of the best commentaries I've heard is about exogenous shocks. And usually,
Mm.
recessions, the conditions are there, whether it's inverted yield curve, the PMIs, the LEI,
Mm.
all those indicators signaling recession. But what actually caused the recession is exogenous shocks that are really hard to forecast.
Mm.
Whether it's the SVB
Yeah,
in this
well,
case. Go ahead.
yes and no. Because I mean, there's definitely some things that you can't forecast, or that don't leave any clue, or that just kind of happen completely out of the blue. Like they're probably more on the natural disaster front. The things that are not possible to predict. Even like with the Russian invasion, it was kind of like with geopolitics. There's always rumblings and noises, but it's quite rare that something actually happens, like what happened there. But there was all these clues.
Yeah.
There was clues in the price. If you followed the right Twitter accounts, the OSINT or OSINT, there's so many clues there. But even then, like that's kind of like a matter of months or weeks on that one. But thinking about financial crises, SVB, FTX, I couldn't have predicted that it was going to be FTX or SVB. I hadn't, to be honest, I hadn't even heard of SVB before last week.
Yeah.
Um, so, but the point is, when you see the monetary tides going out, the interest rates going up, the slowdown happening, asset prices falling, you know that's inflicting pain. And anyone who's been um, running abnormal risk levels, anyone who's been sloppy with their business planning, their financial risk management, those are the bodies that float to the surface first. And it could have been, it could have been anyone, and I think, and the other thing is like, to me, this is all kind of just going up the hill and then coming down the other side. Going up the hill in 2020, 21, massive tidal wave of liquidity sweeping across the world. You had this just procession of little bubbles, so or little manias. So the tech stocks, the crypto, the meme stocks,
SPACs.
the specs,
Yeah.
yes,
Yeah.
and then it's only logical then that when you go down the other side of the hill, the liquidity's being drained out, the tides are going out. You're going to have a procession of many crises. Hopefully, hopefully only mini crises, but
Yeah.
that's the thing. Is that a mini bubble can give way to a broader market mania, or broader sort of upward trend of risk appetite. But then a mini crisis can give way to a sort of snowballing of negative sentiment as well. So um, you know I think it was Ian Harnett of ASR. He's got this chart of the Fed funds rate, and when you have these tightening cycles in the past, and um, each time if you have this tightening cycle, you have a crisis, some crisis, any crisis.
Yeah. Yeah. I saw that chart. Yeah.
The late 90s was the Asian financial crisis. Then and his other neighbour, subprime crisis. Um, you go back in time, you've also got other emerging market debt crises, savings and loan crises. Um, it's kind of natural order of things. People kind of operate as if the conditions of 2020, 2021 are going to continue forever.
Yeah.
When they, when if you're operating your business for perfection, or operating your bank, your borrowing strategy, or whatever your finances, your personal finances for a situation of perfection for into eternity, you're going to get rudely awakened when the cycle just does what it does and it goes down to the down phase.
Yeah, it's the concept of cost of capital is such an important concept. Is really understanding it. Like for us, for trading terminal, right when rates were coming up, we have a business line of credit for funding our development. The first thing we did was paying that off because it was a floating rate, revolving. So said, okay, this cost of capital is going up. You have to
Yeah,
act
yeah,
accordingly.
yeah. If you guys can't see it, then yeah, who else is going to see it?
Yeah, I mean, but a lot of the small businesses and guys who are not in
Mm,
finance, it's their life's gonna get impacted. It's just not understanding
mm,
that. I want to talk
mm,
about some of the leading indicators. One of the
mm,
arguments that I think it's kind of it does make sense. I heard a couple of folks they were on odd lots. They were talking about like a lot of PMIs or a lot of survey data, and they were saying because of COVID and because the supply chain got so disrupted, there were no orders, and then there were a bunch of orders. People were ordering a lot because they wanted to make sure they have inventory,
mm,
and then they didn't order. The data is skewed. So what you're saying is 100, 3,000 purchasing managers that are
mm,
grumpy because they're not getting any order, when in reality they've
mm,
actually got their order in the summer because Nike ordered a lot of inventory. How much truth do you think there is in that argument on some of the leading indicators?
Yeah, I mean, I'm always careful or skeptical when people try to necessarily explain away
Okay.
the data. I mean, I think that we should definitely be questioning it. And if it was just the PMIs, which are among those 20 different things that I was talking about, but they're not the only one. If it was only one thing saying, one indicator, and if it was only a survey, then I'd be sitting there saying this is a possibility. Versus if it's a broad spectrum of indicators all saying the same thing, you know, that are looking at different factors, different regions, and they're all saying the same thing, then it's kind of harder to argue, or maybe you can say, hey, right, we'll ignore the PMI data, we'll just focus on the others, but uh, they're still saying the same thing anyway.
Yeah.
But I think there definitely is something to the inventory cycle aspect to it, and um, we definitely saw it. There was that whole didn't have enough inventory. Let's get inventory. Got too much inventory. And then if demand weakens, then you can actually have to spend a period of time just working through those inventories, not making new orders,
Yeah.
and all of a sudden, there goes demand.
Yeah. Yeah.
So yeah, I mean, yeah, maybe I'm missing the detail of what they were talking about, but it kind of seems to reinforce.
Yeah. No, you're absolutely right. It's just not it's just not the server data. It is there's a lot of data that are
Mm-hmm.
pointing
Mm-hmm.
downward on the leading side. I want to talk a little bit about SVB and everything that transpired. Kind of want to get your input. Are you I don't know, as much as you like to share, because I know some of it is turning to be political now, but what are some of your 2 cents? What do you think happened here, and what could be the ramification of this event?
Yeah, so again, I think it's kind of it could have been anyone, but logical kind of. It's logical that you would have this kind of thing happen at this point of the cycle. In terms of the response, it's Yeah, it is kind of a dangerous, yeah, in some respect, but is it, in the fact, in the sense that if you're just guaranteeing all deposits, then all of a sudden bankers don't need to worry about liquidity risk, or they don't need to worry about, um, they can take a greater risk and, um, you know, basically take advantage of that, which you should expect them to do, because if you understand the way bankers work, anytime you give them an arbitrage opportunity, or anytime you um, remove a constraint to risk taking or encourage risk taking, risks are going to be taken.
Yeah.
So I think that in that respect, you're probably going to create a set of incentives that are going to basically create some monsters, bigger monsters down the track. But then, at the same time, you kind of got to give them credit, because, um, you know, I mean, the fact that they wiped out the equity in the bondholders and saved the depositors is, that's kind of good. I mean, it's hard to argue against that, because the equity holders, the bondholders, they should have known better.
Yeah.
Well, they, the payoff profile, the risk set up for them very different than somebody who, because most people who put money in a bank account aren't looking at it from the standpoint of, oh, what's the credit rating of this bank? What's the balance sheet like? Now that I'm lending them money, most people
Yeah.
don't think about it that way.
True. Yeah.
Um, and and if if there had been any, delay or loss of access to those funds, it would have definitely, that would be very hard landing scenario.
Yeah. That's true.
Um, so it's kind of, and I think too, it's kind of good that we had the financial crisis so recently,
Yeah.
because we've still got the people that went through that, in policy making positions, and that's, the policymakers that you have at a given point, are going to have their biases, their behaviour shaped by what's happened recently.
Yeah.
And so, if the recent experience was a crisis, then they're going to be looking for a crisis, and getting ready for a crisis. If their recent experience was inflation, they're going to be looking at, how to inflate inflation, and that'll be forever what they're looking at. So I think, it's kind of, yeah, you're kind of screwed either way.
Yeah.
I mean, it's kind of what I alluded to before about the banking industry, is that, you know, there's no new way of doing things. It's just, different risk tolerances.
Yeah.
You have to, and it's the same thing with what central banks did with inflation over the last couple of years.
Yeah.
It was, do you want to leave policy too easy for too long, overcook inflation, but avoid double dip recession or delay it. And so we're now dealing with the other side of that risk, decision that they made. Their decision was, we're going to overcook things, and we're going to accept higher inflation, because we well we kind of don't care about inflation at the moment. We're focused on not we're focused on avoiding growth. And so I guess it's a good case study of, or kind of an analog for, what may happen on that respect.
Yeah, it's so interesting. I'm already
Mm.
seeing the narrative on Twitter. A lot of people saying, "Oh, we should just get used to 3 to 5% inflation," and this is a new narrative that is going around. People saying, "Oh, we just should just get used to
Yeah.
3 to 5% because otherwise, the banking collapse." That, saving the depositors. It makes sense because even if you're looking at the capital structure, depositors really sit at the right at the top, right? So and then you got your
Mm.
bonds and then equity at the very low. But it's just one of the things that was really troubling for me per se. And again, I don't want to make it personal because I can go on and on. And this issue was this,
Mm.
especially Silicon Valley and venture capital mentality that, hey, we have to get bailed out. A lot of the
Mm.
folks were estimating the recovery is probably going to be around 80%, 85%, 50% of it was supposed to come this week, and that should be enough to really cover the payroll if payroll was really the issue. But just I was talking with one of my friend who's a VC, and he's like, we can't do a down round. Why not? Do a down round. What's wrong with that? And it just feels to me that they, from all the tweeting, and it just seems to me that the Silicon Valley was willing to manufacture a bank run than to take a 10%, 15% haircut. Am I being too cynical here, or do I have some credibility in my viewpoint? You're a smart guy,
Well,
so I
either
want to
way,
hear from you.
one consequence of this is that bank stocks now should trade at a permanently lower level.
Yeah.
So they have a permanent valuation haircut now because the regulatory risk backdrop has changed, and you know you should expect to not get bailed out if you're a bank equity investor.
Yeah.
Um, and yeah, I mean, I don't know. I think like we have to be a little bit careful too, because you can run into the thing of maybe you're like, oh, we don't like Silicon Valley, we don't like the VC, kind of what they've been doing, so we want them to feel pain. We you kind of have to make sure that you park any biases that you might have, and try to remain as neutral as possible, even though it's quite difficult in this world where everybody's either you're either one extreme or the other.
Yeah.
And what team are you on?
Exactly.
But and that comes back to markets very very acutely, because anytime that you're kind of like wanting to see someone suffer or wanting to see a certain thing happen, you can end up basically creating this reality in your head that you want to impose onto the market, and you end up fighting the market and fighting reality instead of saying, oh, we've got new information, we need to adjust the way that we think. And the best example I have of that, one of the most interesting charts, and this controversial area, but back in 2016, one of the pieces of analysis that I was running was just crunching the numbers on the polls for Trump versus Hillary, and the way that I sort of put it together, and also applied a little bit of a cycles analysis to it, because there's this clear cycle going on, and I was looking at the survey data, and it was basically it's 50-50. It's a coin flip. And then I was looking at the betting odds, and it was priced for like the odds were basically 5 or 10%. And it's very rare that you get like that. Is probably the most extreme market mispricing that I ever seen.
Yeah.
Which I did actually make money on that one.
Oh, did you bet? Oh, that's awesome.
I mean, like, not a big amount, but it's but conceptually, whenever you see a mispricing like that, where everybody's kind of the reality is one thing, but everybody thinks it's the other thing, and that's the perfect situation to try and find. And you just run that simulation enough times, and it's going to make money.
Yeah, yeah. I love that. I love that answer. Sure. You reminded me that I might have
Yeah.
a unconscious bias, so I'll take that out. I'll take that into consideration. You're absolutely right. Let's switch gear a little bit. Talk about commodities, and I mean we talked about leading indicators, and if you kind of want to see commodities maybe as the input in a lot of things, they are basically the ultimate leading indicators. You got lumber really down. I think oil, I didn't check, I think oil was around $60 or something, really down. So they're kind of pointing in a recession, but we're also hearing this commodity super cycle. What's your kind of 2 cents on commodities right now? Are you positioned? Are you bullish, bearish?
Yeah. So I definitely look at commodities at the asset class level. Also look at individual ones when it makes sense. But at that asset class level, and so what I'm talking about there is like the GSCI, which is and actually prefer to look at the light energy one. So a diversified index of commodities. Still bearish. So basically turned bearish shortly after the top there. And the reason for that was, first of all, I designed a set of valuation indicators for commodities, and they were at the most extreme level in recent history, and the most extreme overvalued since the 70s. And so going back to what we talked about earlier, you start with the valuations, and then you go into what does the rest of the picture say? Well, you've got a bunch of technical indicators, tactical indicators that were all pointing to downside risk. And those are like sort of medium term ones. And so it was quite meaningful. Like, and you probably could have just stopped at that point, but then also looking at sentiment positioning, which were way overcooked. They crowded longs, complete consensus that it was
Yes.
bullish, and that's back to that whole super cycle thing. I mean, I think most people were talking about the super cycle after it had gone up 70% already. um,
Yes.
and yeah, you've got to be very careful of when people start talking about super cycles and grand narratives, structural themes, mega trends, whatever rebrand. And usually those things, like when people start talking about structural change or a new thematics, that's usually towards the late part of the cycle. The last time they were talking about these mega trends, it was emerging markets, the way of the future. About 2007 at the peak. Same thing with commodities.
Yeah.
Um, and then you just have this kind of parroting of the narrative, and but you have people kind of that are paid almost to continue that, like the fund managers or advisors or whatever, what have you, that kind of like, let's just type up a note on the structural theme. But back to the point, every indicator is pointing down and is still pointing down. The macro side of things, commodities are definitely very macro sensitive. So recession, growth headwinds means weak commodity prices. So I think they've still got downside. Against that would be the supply situation. So we've just gone through a commodity, and we're still in a commodity investment depression, a
Yeah.
commodity capex depression, and that was part of this perfect storm of the last few years, where you know because of what happened, but because of that being in the background, it was so much more accentuated than it might have been otherwise. And it was the same thing with the shipping industry. That was something I was going on about, is that for a long time shippers have been really underinvesting, and
Yeah.
so and understandably so, because shipping rates had been quite low for quite some time. And then, of course, you have this situation where you turn the economy off, turn it back on again, and everybody needs stuff like computers and office chairs to work from home, and
Yeah.
yeah, of course, that goes up, and then and so yeah, that lack of investment in commodity production supply, I think, probably sets a higher floor for commodity prices, but I think we've still got downside in the meantime.
Yeah, it's. I
Yeah.
think the capex cycle is very important that you mentioned as well. Is we heard that with oil, right? And for the last I think 7 or 8 years, there was lack of capex and investing because that's just the
Yes.
shareholder
Yeah.
wanted dividend and the capital to be paid back to them. So
Yeah. And changing preferences too, like
yeah,
the rise of ESG and
ESG.
different social political attitudes.
Yeah, but Colin, I know we're running out of time. How much more time? I have a few questions, but I can cut through a few of them. How much time do we have? Are you
Oh,
running?
like another 5-10 minutes, I suppose. Yeah.
Okay, yeah, perfect. So yeah,
Yeah.
then with that said, I have. Let me just take a look at. There's so many good stuff. This is like a master class, so I really appreciate your time and being here. with me and our community. Uh,
Yeah, I
so
appreciate
let's
the questions. You've managed to pull some good things out of it.
Of course, no, absolutely. So let's really focus a little bit on our community. So, with variable traders, peak capital trading, it's mostly retail traders, and they get a lot of bad rep when we talk retail traders. People think Robin Hood, really, quote unquote YOLOing, on calls and puts. But our community, and I think retail trading in general is getting a lot more sophisticated. They have direct access softwares. They're discretionary,
Mm,
but they're very
yep.
sophisticated, and they understand these macro
Mm,
teams, and they're constantly learning. Uh, what you are sitting on the professional side, mostly dealing with institutional client. What piece of advice do you have for retail investors and retail traders to navigate this market?
mm. So, maybe a few things. So, first of all, um, educate yourself. Continue to educate yourself. And back to what I said at the start there about having sat on, these different manager meetings and seeing these different ways that people are approaching the market. I think exposing yourself to different ways of playing the game, you know, and in terms of books on that front, Market Wizards is a great book for that. Um, but I think there's, as you're kind of alluding to before, we're in an age where access to information is just simply historically unprecedented, and a lot of the, um, in many respects, I think the playing field has actually been quite leveled. Um, there used to be a massive informational advantage for professional, institutional versus retail, but beyond that, and I think probably the key thing, which also echoes what I talked about earlier, is just really taking the time to think about your framework. What are you trying to do? How are you trying to do it? What are and how are you going to react in certain market environments, and how are you going to recognize different market environments, so that you're not in a situation of uh how do I react in this situation? It's how do I react in all situations?
Yeah,
How do I set myself up for success over the long term versus trying to chase one thing after another, um, get rich quick, all of that bad shit that's just been brought up and encouraged during the last couple of
2020.
years with
Yeah,
crypto and all that. But also, and actually, just to close off the previous point about wanting to look at all these different ways of doing things, but also focusing. So uh, look at all the different ways that you can do it, but then kind of pick one as well. You don't want to be like, oh, today I'm a gold trader, tomorrow, I'm a bond trader, the next day I'm a, day trading this, or I'm long term investing that. Kind of, yeah, and again, that comes back to, maybe even just having one sheet of paper that says, this is what I'm trying to do, these are my goals, this is the way I'm going to approach things, and this is the framework I'm going to use.
yeah, but very well said. I think framework is really important. So, you call it framework. I think I interviewed Brent Donnelly, and Brent called it your edge. Just really, really honing down
Mm,
on what it is that keeps you in the market, and give you that,
mm,
uh, statistical edge per se. Colin, it was amazing having you. I know we went a little over time, so I apologize for that. Truly, for me on my
that's
side,
good.
a master class. I know for our viewers, you have a special offer. So your weekly chart store Substack, you can get
Yeah.
access. There's going to be a link in this video. You can get access to it for a month for free. Is that correct, Colin?
Yeah, exactly. Yep, yep. So
It's
you can come and
something.
see what some of the stuff that I'm doing. It's yeah, the chart storm. I've been doing that since every weekend. Um, never missed a weekend since 2015, I think. Even do it on holiday. um, and it's I guess too, just further little snippet is having some, having a discipline. A weekly discipline is it kind of forces a minimum level of learning and understanding over time.
No,
Yeah, so
absolutely.
come and check it out and see some of the stuff I'm doing.
For sure, it's very exciting. It's with our community. I've shared your charts and your commentary, so
Yeah.
our community knows you. We're a huge fan of you, so really appreciate it. Looking forward to it. I'll include the link in the description of this video. Again, Colin, thanks for joining the show and really kicking off this new series that I'm starting. It was an honor, truly a masterclass. Lots of hidden gem in this conversation. So I appreciate your time.
No, and I appreciate the questions. Yeah, I think sometimes you need somebody to ask some good questions to I even surprise myself with the answers. Yeah, yeah, appreciate it, and yeah, thanks for having me.
That's awesome. Thank you. Our pleasure. All right. Thanks, everyone. And we'll see you on the next show. Have a good one.